Greetings. Welcome back to the continuing lecture in corporate finance. Today's topic is capital structure and leverage. And this is probably the last topic for this semester. I hope we could have also time for dividend policy. Most likely, with the time remaining, we may be able to reach that part. But there's a slight chance that we might reach that topic. But to be more realistic, this might be the last topic. But this is going to be a long topic. So when we say capital structure, you already understand what capital structure is. I mean, from the beginning of the semester, we spent a lot of time discussing, what the capital structure is and what kind of implication it has, and also. Leverage is also the terminology that you already you must be familiar with, because leverage, we know that it means use of debt, especially financial context. Now, the central issue in capital structure is that the leverage helps the company, right? Leverage helps the company to get better results, right? Of course, measured in terms of financial variables, which are EBIT and ROE and EPS, earnings per share, right? So we all know that capital structure refers to the mix of a firm's debt and equity. And for the simplicity's sake of for the sake of our thought experiment and the simplicity of our thought experiment, we would consider preferred stock as debt, because preferred stock is obligated to it obligates the firm to pay fixed payments, just like debt. Now, the financial leverage, right, refers to using borrowed money, right, using the bond to enhance the effectiveness of equity. I mean, the reason it is called leverage is because, just like in the everyday usage of the word leverage, because when you use the word leverage, we can leverage this off, we can leverage something, what does that mean? You use extra boost, right, to enhance the performance. So just like that, financial leverage means using debt to improve the performance of the company. Okay, so leverage using debt, right? In other words, debt ratio has a significant impact on the company's financial performance. Actually, later on, you will see that the leverage is not only limited to the excuse me, using debt. There are two types of leverages. One is called, financial leverage, and the other one is called operating leverage. And we'll get to the operating leverage later on. But for now, we will limit our discussion to financial leverage only for now. Okay. So our central question is, can the use of leverage increase the value of a firm's equity? Well, yes. The answer is yes. Can it increase stock price? Yes. under certain conditions, changing leverage can increase stock price, but an increase in leverage also increases risk. Of course, risk increases, but uh, uh, ROE, EPS, EBIT, I'm sorry, ROE and EPS, they both benefit. EBIT, there's another uh, dimension to that, which involves operating leverage. But so let's take a look at the next. Leverage influences stock price. Yes, we already answered that. Alters the risk-return relationship in an equity investment. Yes. Stock price can go up, but then risk goes up as well. So it measures, and what other measures of overall performance of a company? Of course, EBIT, right? Also known as operating income or operating profit. And ROE, which is net profit or EAT over equity. And then EPS is basically earnings per share. So EAT per share, so divided by number of shares. These are the overall, right, measures of overall performance. Now, if we understand that leverage increases risk, and there are so risk is basically the variance. In other words, variability in the return. Of course, return comes from the price, right? So it causes variability. In price and variability in return. Now, so it is variability or variance in return on equity and earnings per share. Now, so when we define risk, there are two types of risks, right? And from Finance 100, Principles of Finance, you learn that there are systemic risk and non-systemic risk, right? Systemic risk is coming from the macroeconomic system, so it is across the board. It doesn't affect only a single company or a particular company. It is completely across the board, right? All the companies, such as inflation, right? Market risk, right? Financial market risk, interest rate risk, reinvestment rate risk, exchange rate risk. These are the risks that come from the macroeconomic system. So there is nothing you can do about it. But in that's called non-diversifiable risk, because the systematic risk is non-diversifiable, meaning diversification of your portfolio cannot reduce the systemic risk, right, or systematic risk. I mean, there is actually a semantic difference between systematic and systemic, but in the finance context, they are pretty much interwoven. These two concepts, systemic, systemic, they are used in in this to mean the same thing, as an alternate. But there's a slight difference. But we're not going to come back to that if you have time at this point. So, but then what is the non-systematic risk or diversifiable risk? Diversifiable risk or non-systematic risk can fall into two categories: business risk and the financial risk. Okay. Now, the financial risk is quite obvious. Financial risk refers to the leverage. Okay, and some industries are more prone to um, uh, higher leverage, right? Uh, it's not like it varies from one company to another. I mean, it varies from one industry to another, right? And a particular one industry, some industries are more prone to uh, be heavily leveraged than other industries. And for one example, I would say airlines industry. The airlines industry is more prone to be heavily leveraged, and I'm not gonna explain why because that was something already well expounded in the uh, Finance 100. And if we have time after, we can come back later to discuss that. So financial risk adds variation to ROE and EPS, right? Now, what is the business risk? Business risk is risk that is specific to uh, a particular industry due to the intrinsic or inherent nature of the business. For example, uh, think about it. Um, Hotel and restaurant industry would be. I mean, you're witnessing it now. I mean, during this COVID-19 crisis, you see a lot of hotel and restaurant industries, tourism. They are directly and adversely affected by the pandemic. Whereas IT industry, you see hardly any impact to IT industry. As a matter of fact, actually, IT industry is booming because of the a lot of people uh, working online, working, distance learning and all these things, increases the demand for like more IT uh, platforms, more IT solutions like online conferencing and right Zoom, Blackboard, Collaborate. So these are the specific uh, characteristics that are specific to particular industries, right? And initially, right, business risk is the variation in EBIT. Of course, depending on the economy, right, during the recession, most businesses will suffer drop in EBIT, right? During the good economy or economic boom, most businesses will enjoy, uh, uh, increase in EBIT, and they will thrive. So then the total risk is actually, it's missing one thing. It's not the total. I mean, they're not talking about the total risk. They're not talking about the systematic risk. They are only talking about the sum of the business and financial risk. Because think about it. From the risk and variation in EBIT, uh, uh, the variation in EBIT gives rise to variation in ROE and EPS. Right? First, there's something uh, happens to the. I mean, if the earnings of the company drops, then drastically, then of course ROE will drop, and earnings per share will drop as well. Right? Now, but there are when we say total risk, it refers to systematic risk and non-systematic risk, right? So this is only non-systematic risk, and because total risk is not what you can do as a company, because as I said, it because the systematic risk is coming from the macroeconomic system, right? There is nothing a single company can do to prevent it or to avoid it entirely, right? Through leverage or through, financial leverage or operating leverage, right? The best they can do is, reduce minimize the non-systematic risk, such as, business risk and financial risk through, leverage, right? So this is the summary, right? Financial leverage is associated with the capital structure and causes financial risk. Operating leverage is associated with the cost structure, which is the firm's mix of fixed and variable cost. Remember from financial statements, right? Especially from income statement, right? Two sources of expenses is direct cost and indirect cost. Direct cost is also called cost of goods sold, CGS, which is the accounting's terminology. But microeconomics terminology is total variable cost, right? Remember? And then OPEX, the second source of expense, OPEX, operating expenses, right? Also called uh, 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 indirect cost, right? Also called OPEX in accounting, uh, and also called, total fixed cost in microeconomics, right? Which is, so operating leverage as, has a direct bearings on the firm's cost structure. And so operating leverage influences a firm's business risk, and that causes the uh, variation in EBIT. And the variation in EBIT will cause variation in uh, return on equity and earnings per share, right? Okay. So they are, this diagram pretty well, captures the uh, relations between the two, right? So uh, you can just read it up. Well, of course, let's go over this. Well, source of the performance is the business operations, right? Operating activity. Remember the three activities, financing activity, investing activity, operating activity. All the businesses must operate to uh, generate income, right? And the result of that is the EBIT, right? Uh, Operating profit or operating income. And then through the financing activities, right? Uh, it will reach the overall performance measured by ROE and EPS, right? And but there is a variation. To these activities, right? The performance of these activities, variation in business operations, causes variation in EBIT, right? Which is called business risk, and then that causes, through the financing activity, adds additional variation from the effects of leverage, right? So there will be variation in ROE and EPS as a result, right? Through, from EBIT and through the additional uh, risk in by leveraging, right? Uh, which is called financial risk, and you come to the and that would result in the risk and financial performance, right? Okay. So financial leverage may increase the stock price, and this is the point. In other words, not using debt is not necessarily good uh, for the company. I've been telling you over and over. There is an optimal uh, debt ratio or optimal leverage, right? That would maximize the stock price and maximize the returns, right? Return on equity. And it always increases the risk, right? But during the, it will increase the financial performance during the good economy, but may make performance worse during the bad economy. And that's why, risk is increased, right? Based on ROE and EPS performance in good times, investors beat stock price up as debt is increased from low levels. Yes. Uh, effect is eventually mitigated by the increasing financial risk from the leverage. As the leverage increases, right, the cost of the debt, right, cost of the debt increases. Therefore, financial risk increases, and this will wean off or shun off or shy off, wean off some stock equity investors, right? Or shun off equity investors. So under what conditions will increasing leverage improve ROE and EPS? So next slide will show you the example. Okay, so this is the effect of financial leverage under good profitability. In other words, under good economy. So let's take a look at the selected information from ABC, Arizona Balloon Corporation, ABC Corporation. Okay. Oops. So here, this information is basically what? This is no balance sheet information because this is the capital structure, right? The capital structure, debt, equity. Their total, everything is in $1,000. So of course, that means 1 million. The total assets or total capital is 1 million, right? And they're in the 0% debt. That means the entire total capital of 1 million came from equity, right? And then second scenario, 50% debt, so the capital structure is 50-50, 50% debt, 50% equity, right? And the third scenario, 80% debt, right? Okay. So suppose, the shares, how many shares, if shares are current shares are $10, book value of shares are $10, then of course, there must be 100,000 shares outstanding to make $1 million, right? Make sense? Now, if 50% is debt and 50% equity, if share price is, a book value $10, there's got to be 50,000 shares of stock to make up for, to make $500,000. Only 20,000 shares at $10, then that will make $200,000. And below this line, right, after that, then it's all what? Income statement, right? From here to EAT, that's an income statement data, right? Information compiled from income statement. So suppose their revenues are all 1 million, right? On the three scenarios, all 1 million, and their expenses, right? Cost and expenses are all 800,000. So then they all have $200,000 EBIT, right? Let's say interest rate is 10%. Of course, in scenario one, there's no interest because zero debt, right? In second scenario, 10% of 500,000, 50,000, right? Third scenario, 10% of 800,000, 80,000. So earnings before taxes will be, this one will be completely 200,000, 150, 120. And if the tax rate is 40%, what's going to be the taxes? This times 40, 40%, 80,000, 60,000, 48,000. So what's going to be the EAT? 120, 90,000, 72,000. Okay. Now, what is the return on equity? Return on equity, EAT divided by equity, right? This divided by this, then 12%. 90,000 divided by this, 18%, right? 72,000 divided by 200,000, 36%. Now think about it. Which one has the highest return on equity? And it's the return on equity that the investors, equity investors, are after, right? And look at the earnings per share. You divide this by the total number of shares, then it's $1.20. Divide this by the total number of shares, $1.80. Divide this by the total number of shares, $3.60. Also earnings per share, which the stock investors are after, right? So which one has the best performance for the equity holders? 80% debt, right? This is the advantage. That's why it is called leverage. Using debt is called leverage because it levers up, right? It leverages up the ROE and EPS, which are the main uh, indicator of the performance for uh, equity investors, right? Okay. So then our question is, so how do we know? I mean, can we just keep leveraging? Then can we just keep leveraging? I mean, since leverage helps the stockholders, right? Uh, can you leverage, indefinitely? I mean, 100%. Theoretically, 100% leverage, 100% leverage would give you the maximum, right? ROE and, but then think about it, earnings per share. If 100%, it's like, think about, let's compare it to buying a car. First of all, it goes without saying, 100% leverage will give you the maximum financial risk because if the interest rate goes up, uh, the most of your EBIT will be exhausted in paying the interest expense, and you will have nothing after paying the interest. I mean, in the extreme case scenario. But also, let's use an example. Let's compare it to use a comparison, right? Suppose you're buying a car, right? And when you buy a car, right? You have two options. You can, if you're buying a $50,000 car, or you can, if you have money, you can pay cash up front. Entire, you can foot the bill. Entire 50,000, right? If you're a billionaire, like $50,000 is just like a piece of a peanut, right? Uh, but then even a billionaire would not pay up front, right? Not going to pay use cash to buy the car, and is not going to pay. Even a billionaire will not pay lump sum cash. Why? As long as he's a smart person, he or she wouldn't do that. Why? Suppose you can borrow money, right? You can borrow, let's say, up to maximum $50,000, and if the interest rate is 5%, right? Annual, of course, annual, right? Um, you will have to pay 5% interest, annually, right? But you didn't spend your $50,000. So what do you do with this $50,000? If you can find a lucrative investment opportunity, let's say you invest in a portfolio of stocks or just even a single stock. You don't do it, you don't put money in a single stock, but let's say you found an investment opportunity that will return 10% a year. Now then think about it. And if things go as expected, so every year, you get 10% return for the next 5 years. Does In this scenario, doesn't the loan automatically, finances itself? I mean, it pays for itself. Doesn't it automatically pay for itself? Isn't it right? Because the 10% return from your investment can more than pay for 5% interest on the loan and still leaves you with the other 5%, right? Okay. So that's the reason why, even if you're a billionaire, if you're a smart person, uh, if you're a rational person, you wouldn't uh, you wouldn't pay uh, you wouldn't pay for the car with cash up front, right? In lump sum cash, right? But then, if you think about it, then uh, I mean, I just gave you a hypothetical situation. In this hypothetical situation, you're borrowing the entire 50,000. But then this doesn't make any sense to the bank. Why? If the bank is footing the whole bill of 50,000, why would the bank lend you the money? The bank can buy the car outright for themselves, and the bank can rent it out to you, right? Why would they let you have the ownership of the car? Of course, the title. If the bank is, uh, I mean, when you borrow money from a lender, the title of the car or the title of the property is with the lender until you pay it off, right? But then that's why you make the down payment, because by making a down payment, you have even 10% down payment or 5% down payment. Normally, down payment is conventionally about 20%, but doesn't really matter. 10, 5, it doesn't really. Even a perfunctory, just symbolic token down payment is accepted. Uh, but the idea is, if you make a down payment, that's your own equity, right? So if 5% is equity, right? You made 5% down payment, then the capital structure is 95% debt, 5% equity. Make sense? Um, so under what condition, right? Does financial leverage help? Does it help? For as I said, if your equity is then if the capital structure is 95% debt and 5% equity, will it still? Of course, it will still do good, but then the question is, uh, the risk is very high. It's going to be very high. Financial risk is very high. It's also called financial distress because the distress from servicing the debt is tremendous. There will be nothing left for the company. Everything, all the earnings will be exhausted in paying debt. Uh, but let's get to the new concept, return on capital employed. Right? Return on capital employed. You understand what return on equity is? and you understand what return on asset is, and you understand what return on investment is, return on capital employed, and this is like return on both debt and equity. Now, capital, when we say capital, we made it very clear. We made a distinction. What's the difference between capital and asset? Capital means only the long-term source of capital. In other words, uh, long-term debt and equity, right? Current liabilities are not considered as capital, right? So anyway, you would like to know, I mean, just like return on assets. So this is a concept that is like return on assets, but just accept the uh, current liabilities, right? It measures the profitability of operations before financing charges, but after taxes, right? On a basis of comparable, on a basis comparable to return on equity. Yes, think about it. Return on equity is purely uh, the harvest of the fruit, right? I used this analogy before. I mean, your investment is like a company is like an orchard. Orchard has apple trees, fruit trees, or and the trees would bear fruit in the harvest season, in the fall. That fruit, so the trees are like your assets. Trees are like your total assets, right? And the fruit, right? Fruits are like um, the return, right? EAT, right? So the harvest of fruit. Um, so it only makes sense that when you measure, I mean, the trees were bought with equity and debt, right? Remember? And then the harvest of fruit, belongs only to the equity holders. Nothing, it doesn't belong to the debt holders or creditors. Of course, the debt holders and creditors got their cut already. Interest payment is already what they got. And if we, some of the apples, some of the fruit have been used as, probably as interest payment. But whatever is left, right, is totally that's the you know uh, EAT that belongs to solely to the equity holders, right? So that's the concept of return on equity. But then uh, to compare that with the concept of but think about it. When we did ratio variables, right? When we did ratio analysis, I said, so how do you measure return on assets? uh, I mean, what's the difference between return on assets and return on equity? um, Return on assets is basically they use the same numerator, which is EAT, and divide it by equity. One is divided by equity. The other one is divided by total assets. Okay, so uh, from the bondholders' perspective, the bondholders don't need to look at the return on equity because it has nothing to do with them. The bondholders would have to look at the return on assets, right? But then I if it is EAT, I mean ROA, return on asset, has EAT as the numerator, how does that ratio relate to the bondholders? Because EAT has nothing to do with the bondholders, right? Um, at the time I said, that's why there are two measures, there are two measures for ROA. One is, EAT over total assets, and the other one is EBIT, right, over total assets. Remember that, right? Because EBIT still has the something for the bondholders or debt creditors, because EBIT literally includes interest. So that's the cut that goes to the creditors. Okay. Yeah. So return on capital employed is pretty much like the concept of ROA, right? With the EBIT on top. Look, but then the difference is, look at this. It's not total assets. This is total capital, meaning, it's long-term capital only, long-term capital. Now, then on top in the numerator, what do you see? It's EBIT adjusted for the tax rate, adjusted for the tax rate. Think about it. Tax is not something you can touch, right? And so anyway, EBIT that belongs to both equity holders and bond holders are the after-tax EBIT. So this is the after-tax EBIT, right? So this is exactly the ratio. This is the exactly the profitability ratio to the long-term capital holders, right? After adjusting for tax. So if you think about it, there's a tax advantage to the debt holders, right? Because the interest is tax deductible, meaning that actually the cost of debt benefits from tax, right? Tax rate, which is called, tax shield, right? Even if the cost of debt is 10%, right? Because if tax rate is, 40%, right? The company gets the company gets the benefit of tax shield by, so that the actual burden to the company, actual, interest burden on the company is less by the tax rate, right? So think about it. This is the benefit from the debt, isn't it right? This is the return. In other words, interest or return on debt that you have to pay to the debt holders or bond holders or creditors, but that burden is mitigated by as much as the tax rate, right? Benefit to the debt. Now, as long as return on capital employed is greater than the tax benefit to the company, right? In other words, the cost of debt is still less than the return on capital employed. What does that mean? you can keep using debt until, right, these two rates become equal, right? In other words, there's still juice to squeeze out from the fruit. There's still, uh, by using debt, there's still the return on capital employed uh, uh, is still, good. In other words, when return on capital employed is equal to cost of debt, what does that mean? No more juice to squeeze out, right? There's no more juice to squeeze out. So, but then when these two rates are equal, and no more juice to squeeze out. And then if the cost of debt is greater than return on capital employed, look, there's no benefit anymore. No juice to, not just, no more juice to squeeze out. It's actually harming the fruit. It's actually, shriveling the fruit, right? But you don't want that to happen. So that's the idea behind it. Now, this is the opposite case. In other words, it was, on the good economy, same ABC company, Arizona Balloon Corporation. So let's take a look at this. Again, a 0% debt, 50% debt, 80% debt scenario. The total capital is 1 million, 1 million, 1 million. Equity 1 million, 500,000, 200,000. 100 at 10%, at $10 book value for equity. 100,000 shares, 50,000 shares, 20,000 shares. Same revenue, 800,000, 800,000. Cost 720, 720, 720. Just like the previous example, $80, 80,000, 80,000 EBT, 10% no interest, no 50,000 interest, 80,000 interest. Look, this is obviously EBIT cost is different. EBIT is different from the previous example. In the previous example, let's go back to the previous example. Oh, cost is 800, EBIT 200. At least it's 200. 800 cost. Oh, revenue was a lot smaller, right? And what does that mean? If lower revenue, smaller revenue means what? The economy is in recession, or it's not a good economy. I mean, when the revenue was like 1 million, that was good economy. 20% drop in the revenue means bad economy, recession. When the recession is when the recession is the economy is in recession, recession is full blown, revenue is smaller, cost is smaller, your EBIT is smaller. But still, you have to in this, if there is 0% debt, then because there's no interest, the entire EBIT is EBT, right? With 50% debt, with interest of 10%, your EBT will be 30,000. With 80% debt, your EBT is 80,000. So there's nothing. Your interest is 80,000, so EBT is nothing, right? You pay no taxes, right? Because you don't have any EBT, right? EAT, 0, right? So think about it. In this case, ROE, both ROE and EPS has worsened, right? Um, and then 0% debt is um, good. Uh, I mean, a 0% debt scenario gives the best performance, and high leverage gives you the worst performance, right? But this is using a common sense. This is also, this is what is expected. In other words, suppose you are, uh, suppose you have $10,000 and you invested in the stock market, 10,000, right? And the economy is good, stock market is booming. Um, uh, so your return was like 30%, 30% return. That means with $10,000, let's suppose 200%, 100% return. You put $10,000. 1 year later, it came back uh, as $20,000. That's 100% return. Wonderful, and you get then ambitious or greedy once that happens. It's mostly due to the good economy, but you think you are natural. You're a born investor. You're natural. So what do? Um, in your mind, you thought, oh, it's too bad. If only I had 100,000, not just 10,000. I could have doubled it, right? So with 100% return, 200,000. So then, you get, you're looking for, let's say, you're looking for a borrowing opportunity. Suppose with only, suppose you get, you can borrow $90,000. Then that's going to make $100,000, right? So that's like, 10%, 90% capital structure, right? 10%, 90% capital structure. So if the economy is still continues to be good in the second year, you will invest in $100,000 and it will come back as $200,000, right? And because you borrowed only $90,000, let's say you pay 10,000 as um, interest, right? So then you pay back, 100,000, right, to the lender, but still, 100,000, you still have left $100,000, right? Right, for yourself. Your EAT is $100,000. Then what was your equity? Your equity was 10,000. Your equity was 10,000. So with what would be your return on equity? Your return on equity would be then like 900%. Isn't that right? Because your pure EAT is 900,000, right? With $10,000, you got uh, $90,000. So that's 900% return. So that's possible during the good economy. But then let's say it was uh, the other scenario. The economy was bad. So with $100,000 that you invested, the return was, uh, I mean, during the bad economy, uh, the, this investment might even shrink. But let's say you didn't even shrink. It didn't even shrink. So you still maintained, 100,000. But what does that mean? That's 0% return. But then with 0% return on capital employed, on 0% on debt and equity, your total capital, right? You have to pay back $90,000 principal, and then plus $10,000 interest you promised. You pay that back to the lender. What do you have left? You have zero left, right? You have zero. I mean, in this case, at least you are lucky because I mean you lost basically to you. Your return on investment, your return on equity was what? With you don't have even $10,000 left, right? Your original equity of 10,000 left. Uh, what does that what does that make you? I mean, what does that make the ROE? What does that turn? Uh, what does that make for ROE? Actually, that's negative 100% return on equity for you. Isn't that right? You lost all your, right? Negative 100%. So at least in these two examples, right? You can understand what is the downside of that's usually called margin trading. In margin trading, it's like you had $10,000 and you had a lucky streak, and then the broker will offer to lend you $90,000 as some interest, but then when you use the margin, uh, which is basically borrowing, right? And if the economy is good, things will work out fine. But if the economy is bad, or sudden, unexpected black swan, the adverse event, like pandemic, market tumbles, and you lose, you lose, 50%. I mean, so out of $100,000, it became $50,000, right? You lost 50%. You still owe the broker 90,000 plus 10. You still owe the broker 100%. But even if you liquidate all your, positions, still that's only 50,000. After paying 50,000, you still owe the broker another 50,000. This is gonna be a hell. There's it's called margin call. Once you hit the margin call, then they will come after you like not just alligators or sharks. They will come after you like piranhas, right? It's gonna be very, very painful, and anyway. So when ROCE is less than after-tax cost of debt, think about it. What's the after-tax cost of debt? Here, interest is 80. So it's going to be 6%. After cost of debt is 6%, right? And what is ROCE? 80 over 80. I mean, if you calculate it, this minus 1, this times 1 minus tax rate, which is 40%. So this times 8 times 0.6. That would be like, 0.6, 46,000. 46,000 over 1 million. That's 4.6%, right? 4.6%. 4.6% is less than after-tax cost of debt, which was what? 6%. You see what? Exactly in that case, increasing leverage reduces EPS and ROE. That is, along with increasing risk, it has a very negative effect on investors. stock price falls. Okay, got that? So here's an example of another example. Now selected financial information for Albany Corporation is as follows. Albany Corporation at $10 million debt, right? Except everything is, in thousand except for the number of shares, right? So these are the EBIT. So this is, income statement information, right? Data from income statement. This is the data from balance sheet, right? So their total capital is 100 million. Total capital 100 million. Equity is 90 million. Number of shares 9 million. So book value of the stock, book value per share is $10, right? And the from EAT, ROE would be this divided by, this will be 15%. Earnings per share, EAT, right? Divided by number of shares, $1.50. So the treasurer feels that debt can be traded off for equity without immediately affecting the price of the stock. Okay, if you trade debt for equity, of course, eventually it will, because there's more debt, right? A stock price would go down because of added financial risk. But let's say immediately it's not going to affect the price. In other words, the book value will still hold. The management believes it is in the best interest of the company and its stockholders to move the firm's earnings per share from its current level of $2, from current level up to $2. Currently, earnings per share is $1.50. They want to raise earnings per share to $2. Through what? Through increasing leverage, right? Okay. However, no opportunities are available to increase the operating profit. Okay. EBIT's not going to change. It's simply rebalancing of the capital structures. Through rebalancing of capital structure, right? Reallocation of debt capital structure. They want to simply, through reallocation, rebalancing, they want to raise stock price and earnings per share. Will borrowing more money and retiring stock raise Albany's EPS? If so, what capital structure will achieve earnings per share of $2? Okay. Now, first, so this is a two-part question. First, what capital structure? I mean, borrowing more money. First, part one, part A, borrowing more money. In other words, increasing leverage, and changing capital structure. Will it raise Albany's earnings per share? That's part A. And part B, if so, what capital structure will achieve exactly $2 earnings per share, right? So first, yeah, we can check if it's gonna raise stock price and earnings per share by checking if ROCE, return on capital employed, is greater than after-tax cost of debt, right? After-tax cost of debt, or not. And if ROC is greater than after-tax cost of debt, then it will still, increasing leverage will help the financial performance, right? Otherwise, it won't. So let's take a look at that. So earnings per share will, yeah, that's what I said. So let's calculate ROC, which is, EBIT times 1 minus tax rate over total capital. Total capital is 100 million, right? EBIT 23.7 million. So yeah, EBIT 20, and then yeah, 100 million, right? It comes to 14.2. Okay, and what is the after-tax cost of debt or adjusted cost of debt? 12% is cost of debt, and 1 minus 0 comes to 7.2%. So it is less than ROCE. So therefore, trading equity for debt will increase earnings per share. And then they say, the book says, this slide, using trial and error method, we can determine that 45 million is the approximate. Using trial, you have to try plugging in numbers to find that, but that is very unscientific method. I mean, how much time, how much trial and errors will, how many trial and errors are needed to get to the exact number? That's going to be, so that's not very efficient method. Instead, I can nail the exact amount of debt by solving this equation, right? EPS equation, earnings per share equation for debt. So let's take a look. First, we all know, and this is what I did. The book never, introduced this method. We know earnings per share is what? ROE, return on equity, times book value per share. Isn't that right? Return on equity, right? So if book value per share is $10 and return on equity is 20%, now obviously, $2 earnings per share is $2, right? So book value per share at time t plus 1, the next period, book value per share will be $12 then, right? This is something we did at the beginning of the semester. Well, return on equity, if you think about it, is EAT. That's, we know already by definition is EAT divided by equity. And what is EAT? EAT is EBIT minus interest times 1 minus tax rate. Isn't it right? So EBIT minus interest is what? That's EBT. From EBT, if you subtract EBT times taxes, right? That's EAT. So basically, if this is EBT, then this is, EBT, and this is tax amount, right? So by, basically, if you factor out the common factor, think about it. If tax rate is 40%, from EBT 40% is tax rate, the other half, or the other, not the half, the other 60% is the EAT. That's why 1 minus tax rate. But this interest is even further benefiting well, anyway, what is the interest? Interest isn't interest exactly, cost of debt times debt? Yes. So that's why I wrote it that way. And then equity is then, total capital minus debt. That's equity, right? equity plus total equity plus debt, long-term debt is total capital. So if I rewrite the earnings per share this way, earnings per share, right? ROE, which is this, so EAT, which is, can be, this is what it is, right? EBIT minus interest, right? Which is, cost of capital times debt, times 1 minus tau, right? Over total capital minus debt, right? Which is equity, right? Times book value per share. So this is this, right? This is this, right? Then we simply solve this equation for debt, right? Solve this equation for debt. Of course, it takes, you will need to rearrange this formula to solve it for debt, right? And then, so plug in the target earnings per share, right? And going through all that and solving for, there's only one unknown, right? Which is debt. So if you solve for that, it comes to 45 million, right? 156,250. Okay, I nailed the exact amount of debt here. 45 million. It's just approximate, right? The book author of the book probably was too lazy to work out this formula or come up with this formula. I came up with this formula. Okay, nobody. It's not anybody's work. It's my own work. I should have copyrighted this, but I don't think any one of you will steal this from me and copyright it. uh, but this is my own, formula, right? And I nailed it. I nailed the exact amount. Okay. All righty. So this is, how you find the target leverage, target debt level to achieve the target earnings per share. Okay. All righty. So that's it for today. I'm gonna let me. I will see you guys in the next class. End of video.